this really affects you. The ideal inflation rate is 0, just like the ideal theft rate is 0, but that is not the world that you and I are living in. So when the latest inflation number was reported at 7.7%, understand that that was actually the lowest reading in 9 months. Oh, well, that must be because the Inflation Reduction Act finally kicked in, right? I cannot keep a straight face on that one. Oh, come on. Could there be any other plausible explanation than that? But this 7.7% reading had gargantuan effects across the financial world, and it affects you. So settle in, because by the end of this video, you'll understand why, and with some things that you've never thought about before. Also, we're going to have a firm prediction on whether or not inflation has finally peaked. You'll get that here in this one too. Hi, I'm Keith Weinhold. This is Get Rich Education. First, let's explore the depth of the problem. Over the past few weeks, I went grocery shopping in New York, Pennsylvania, Washington, and Alaska. And let me tell you what happened. Though I'm a pretty healthy spender, it doesn't pay to be cheap. Money is an abundant resource, not a scarce one. Yet I've got to tell you, though, that my jaw nearly fell on the floor because of the price of consumer items, from a lean cut of steak or bison to a canned cold brew coffee and almost everything in between. And one outcome is that I am the proud owner of my first ever bottle of $8 salad dressing. Here it is. And at least we do have the good stuff in there, like organic apple cider vinegar. The past few months, a record share of Americans said that inflation was their #1 financial problem. The people in charge of this nation and this whole thing, they've really been playing the blame game. President Biden, he blames inflation on external shocks like the health crisis and the war in Ukraine, and Biden's opponents pin it on the stimmy-happy politicians. Others say that inflation began back with the Trump tariffs, and then yet others argue that the Fed is at fault for misreading this whole situation and not hiking interest rates sooner. And go ahead and comment below on who you think should be blamed for inflation if you like. But divisive partisan commentary, that sort of thing, isn't helpful at all. And the blame game, it doesn't help you in the short term at all. So let's talk about how inflation is affecting you as an investor, now that I've talked about the consumer. And let me tell you, there's a real lesson in how the whole economy works right here, because a lot of what happened when inflation was recently reported at that 7.7%, and that was not just the lowest reading in 9 months. See, the thing is that reading was lower than expectations. Well, this made the stock market surge, and immediately on the lower inflation news, the 30-year fixed-rate mortgage fell over Niagara Falls. It plummeted an eye-popping 0.6%. Yeah, that happened all in one day, and this is Mortgage News Daily's record single-day drop ever. And as to why this happened, all right, this response is because the Fed has been raising the Fed funds rate in order to cool inflation, and markets were rejoicing that the pace of the raises should chill out now that inflation headed downward. Maybe the rate hikes are working. Since raising rates slows the economy by making loans for everything from homes to cars less affordable, and because raising rates also incentivizes savers to put money in a savings account because savers get a higher yield with higher rates, well, if that phenomenon now has an end in sight to raising rates, then companies can be more profitable again, and people will want to invest rather than save again. And a growing chorus of professionals feel that this is it. This is the Fed tipping point. This means they'll stop raising rates 0.75% at every meeting. And yes, almost everyone hopes that point guard Jay Powell clanks a three-pointer at next month's meeting and just throws a brick up there, that he misses, and that they only raise rates 0.5 point because inflation is still elevated. It's just not as elevated as much as it had been. In fact, just last week, one Federal Reserve official rudely reminded everyone that rate hikes are not over. Inflation remains unacceptably high. That's what St. Louis Fed President James Bullard said. And so far, the Fed's rate increases have had only limited effects on observed inflation. That is what he said. So yeah, more rate hikes are probably coming. But get this, this was a bombshell. Moody's Analytics chief economist Mark Zandi, he is quite well respected and widely quoted. He made the call that inflation has definitely peaked. Yeah, he actually used those 4 words. Inflation has definitely peaked. That is a bold line in the sand. Now, higher inflation, that correlates with higher mortgage rates, which is about all that you've seen for a year and a half now. Then, of course, lower inflation correlates with lower mortgage rates. So what does this mean to you as a real estate investor that buys properties to rent out to others? Well, here at Get Rich Education, you are lucratively immersed in the worlds of real estate pays 5 ways and the inflation triple crown. And if you don't understand all that, check out the 3-part Inflation Triple Crown video series if you haven't. It is a free masterclass on how you can profit from inflation 3 ways at the same time, which I'll put that video series right up here for you. That is a dense education that's going to give you a giant investing tailwind for the rest of your life. Well, if the future does have both lower inflation and lower mortgage rates, that's really just a wash to you in a sense, because on your investment real estate, you're going to make less from inflation profiting since your debt won't be debased as fast, and you're going to make more from cash flow and from principal pay down. And right now, inflation still being elevated like it is, all right, well, with that still elevated, you're going to make less from cash flow and principal pay down and more from inflation debasing away your fixed mortgage debt for you. So see, as long as you're in real estate like this, you're winning either way, where for a lot of people, they can only win if the market goes up. So income producing property with a loan plus real estate values are stable. That's a profitable long-term formula. What if you own an investment asset that you knew, just absolutely knew 100% that it was going to depreciate? Well, you'd get rid of it as quickly as you prudently could. Well, that asset that I'm talking about is a dollar. That dollar in your pocket is a quickly depreciating asset. Wouldn't you either spend it before inflation further debases it away or trade it in for real estate? And, you know, it's exactly these types of decisions that create this divergence between becoming wealthier or becoming impoverished during inflationary times. So in inflationary times, get out of dollars and into real assets and debt. And that's why it's a really tough argument to think that there's a better place, any better place to be today than investment property with a mortgage loan that's going to generate yield from rents. You know, all these negative real estate headlines that one reads in mainstream media, they're all about the primary residence market, not the lucrative rental market. Besides stable prices, you've got higher rents that are increasing at a faster pace than usual, and a tenant that pays all of your mortgage interest for you. In fact, when it comes to prices, the NAR forecasts 10% home price appreciation for this year, which is nearly over, 1% home price appreciation for next year, and another 5% in 2024. That's just appreciation. Your total rate of return, when you account for appreciation and cash flow and tenant-made principal pay down and tax benefits and inflation profiting, that total rate of return, you know, when you add up all those profit centers, anything less than 20% per year would actually be disappointing. And that almost sounds irresponsible to say anywhere else in the investing world. So yeah, this is just with regular buy and hold real estate investing that's carefully chosen. You carefully choose your buying. And if that's all new to you, check out the Real Estate Pays 5 Ways video series. They are the most valuable 60 minutes of investing videos that you will ever see. 5 videos, they average 12 minutes each, one for each of your 5 profit centers. I'll put that right up here for you. And then remember, for every mortgage you get, this still elevated inflation, that cannot touch your principal and interest payment. It stays fixed for 30 years while your rent typically rises, and you can buy properties conducive to exactly this strategy, and believe it or not, in safe neighborhoods for as little as $150K sometimes, up to about $300K at GRE Marketplace. It's where I buy my own properties for my own portfolio. And since you don't intend to occupy the property yourself, it typically is going to take a 20% down payment plus the same 4 to 5% closing costs and prepaids that you would have on any property. Wealthy people's money either starts out in real estate or it ends up in real estate. It's either one or the other. Inflation, it can either impoverish or it can gradually enrich you. And since you and I can't control the rate of inflation ourselves, I think we know what side we would rather be on. I'm Keith Weinhold. I will see you over there at gremarketplace.com. There is upward pressure on rents. And you can make this actionable at our sister website, gremarketplace.com. This is where you can leverage my industry contacts to get started with rental property. I own properties with a lot of these same providers across different U.S. states. Most of these properties which I've actually never seen in person before. And how can I have the confidence to own rental property without ever having seen it? Well, for one thing, I partner with these turnkey real estate companies, which you can do as well. I'll see you over there at GRE Marketplace.